Now, I'm not going to waste your time, and I'll cut straight to the point. California, the crown jewel of American real estate, the state where they're not making any more land became a religion, has the most fragile housing map in the country right now. And what lines up for 2026 isn't a soft landing, it's a convergence. Mortgage resets, insurance squeeze, a commercial real estate maturity wall, climate shocks that swing from mega fire to mega flood, and a jobs map still reshaping itself after tech's whiplash. If you think 2008 was bad, pay attention, because this time the vulnerabilities aren't hidden inside exotic mortgage bonds. They're right there in your escrow, your insurance renewal, your tax bill, and your employer's badge policy. Here's what they don't want you to know. The same forces that push California's median price toward the stratosphere are now meeting immovable obstacles. Prices remain nosebleed high, even after cooldowns, while the basic cost of owning, insurance, taxes, maintenance, and financing keeps grinding upward. As of summer 2025, statewide medians are hovering in the $830K to $885K range, depending on the data set you pull, levels that only a thin slice of households can support without financial contortions. That is not a stable base for a rising rate, high-risk world. So let's map the fuse and why 2026 is the year it could burn through. The insurance vice that's crushing affordability. If you haven't tried to bind the homeowner's policy in California lately, brace yourself. Major carriers have paused or limited new business. Some are non-renewing slices of existing policies. The state's insurer of last resort, the FAIR Plan, has exploded in size, crossing 3,300,000 policies by spring 2025 and surpassing 300,000 by early 2026 because more homeowners simply can't find a private carrier at any price. When more people are forced onto the last resort plan, costs and fragility ripple through the whole market. State Farm publicly acknowledged non-renewals for tens of thousands of California policies and spelled out why underwriting here has become so difficult. When large carriers pull back, transactions fall through, closings get delayed, and buyers revise offer prices or walk. Multiply that across thousands of escrows and prices don't drift, they gap. Why does this point to 2026? Because insurance is becoming the non-negotiable gatekeeper. Lenders won't fund without it, and more zip codes are flirting with the FAIR Plan as the only option. Meanwhile, wildfire and wind exposure aren't the only concerns anymore. Flood risk from back-to-back atmospheric rivers is now a modeled state-level worry, and those models are sobering. The updated ArcStorm 2.0 research, peer-reviewed, finds the odds of a catastrophic flood sequence have roughly doubled in a warming climate. Layer that on top of an insurance market already stressed by megafires, and you get price-cutting sellers who just want out before the next renewal. Climate whiplash, from drought to deluge, and the Central Valley pivot. California's climate problem is no longer binary, it's both. In 2022-23, clusters of atmospheric rivers caused billions in damage, followed by new rounds of storms in 2024-25 that triggered emergency flood responses across the state. This is not background noise, it's underwriting input. If flood and debris flow risk is rising in parallel with fire risk, the actuary math resets. Insurers price that in first. Buyers discover it at closing. And inland? The San Joaquin Valley faces a long, grinding water realignment under SGMA. Analysts estimate farm water availability will decline about 20% by 2040, implying substantial land following over time. That's not tomorrow's crash trigger. It's a structural drag that weakens incomes in select counties, weakens local housing demand, and makes cheap rural homes cheaper still. At the risk that ArcStorm-style floods can also hit these very basins, and you see why certain Central Valley submarkets look overexposed.
The CRE maturity wall meets the Bay Area's vacancy. Office isn't housing until it is. San Francisco's office vacancy has been above 30% for 7 straight quarters, with Q2 2025 at 31.6%. That's not a blip, that's a reset. Now put that vacancy next to a national wall of commercial mortgage maturities running through 2026. Lenders facing write-downs and extensions in the office stack aren't eager to juice residential credit risk at the same time. Tighter bank balance sheets bleed into jumbo approvals, construction lending, and bridge financing. Liquidity is oxygen. 2026 looks short of it. When downtown towers hand back keys or refinance at punitive terms, it ripples. Fewer high-paying jobs anchored near urban cores, fewer corporate relocations, and a slower churn in the move-up buyer pool. That does not mean every Bay Area neighborhood crashes. It means the cushion is thinner if another shock arrives. Jobs, migration, and the RTO swerve. California's pandemic-era population losses have started to stabilize as international migration returned in 2024. But net domestic outflow hasn't snapped back to boom time norms. Translation, the state's buyer pipeline is no longer a one-way escalator up. At the same time, big employers are tightening return to office policies, pulling hybrid workers closer to urban job nodes. But with office demand still uneven, it's a messy in-between that keeps some suburban, ex-urban demand alive while leaving downtown housing exposed to longer recovery arcs. The mortgage time bombs that tick quietly. No, we're not back to 2006 liar loans, but after rates spiked, the ARM share of new applications climbed back near 10% at points in 2024-2025. Many 5/6 ARMs written in 2021-2022 hit their first resets in 2026-2027, right when insurance, taxes, and maintenance costs are already elevated. Even if caps limit the step-ups, households on tight budgets will face payment friction in lockstep. A reset doesn't have to be catastrophic to force listings when savings are thin and equity is flattening. 2026. Why that year could be the breaking point. 1. Insurance availability and price. Fair plan enrollment has surged to historic highs, premiums are climbing, and private carriers remain cautious. If 2025-2026 brings another severe fire or flood season, reinsurers will reprice risk again. And that means fewer qualified buyers, more busted escrows, and deeper price cuts in the hardest to insure zips. 2. The CRE office maturity wall. Billions in office loans must refinance into a market with high vacancies and lower valuations, especially in San Francisco and parts of LA. If banks and bond investors take losses, appetite for all real estate credit, including residential, tightens. Fewer loans equal fewer buyers equal lower clearing prices. 3. ARM resets and rate stickiness. Even if 30-year rates ease, resets can push payments up for 2021-2022 ARM cohorts. A modest uptick layered onto higher insurance and tax bills becomes the straw that triggers listings. A reset doesn't have to be catastrophic to force listings when savings are thin and equity is flattening. 4. Climate shocks. Arc storm-type flood sequences aren't science fiction. The probability is materially higher in a warmer climate. Cat losses that fall in the wrong quarter don't just damage homes, they choke lending, push back carriers from the table, and stall transactions for months. 5. Affordability gravity. With median prices still about 8 to 10 times many local median incomes, the elasticity left in the demand curve is limited. Lower rates help, but ownership costs beyond P&I, insurance, taxes, HOAs, now eat more of the buyer's wallet than in prior cycles. At some point, buyers stop stretching.
Where it could hit Hearst and hardest. Coastal wildfire corridors and canyons. Not because demand is weak, demand is eternal there, but because insurance availability is the new gatekeeper. Sellers will discover the buyer pool shrinks when carriers balk. Price cuts follow. Urban core is tied to struggling office stacks. SF proper and a slice of DTLA multifamily condo buildings will keep trading, but liquidity, appraisals, and HOA special assessments will matter more than comps. Vacancy in Class BC offices keeps bleeding into neighborhood economics. Central Valley French markets. Long-run SGMA water reductions plus periodic flood risk equals lenders and insurers price harder, buyers become choosier, and cheap can get cheaper. Short-term rental heavy pockets. Strict city rules, SF, LA, and others, plus higher insurance costs reduce the investor calculus. Fewer cash flow buyers means more sensitivity to macro shocks. Regulations vary by city, always check the local ordinance. What could prevent a full-blown crash? It's not all doom. A few offsets exist. Supply is still constrained.
Even with new pro-housing bills advancing in Sacramento, it takes years for policy to translate into keys and doors. Tight inventory props up prices until it doesn't. International migration is rising again. That backfill helps the rental market and eventually ownership in select metros. Rate relief. If mortgage rates fall decisively below 6% and stay there, monthly payments improve enough to pull some demand forward, though insurance and taxes still blunt the benefit. But could crash is in the title for a reason. The downside cocktail for 2026 is unusually concentrated in California. Your action plan. Owners, buyers, investors. If you own in high-risk SIPs, get 2 to 3 insurance quotes before listing season. If you're forced onto the FAIR plan, price to that reality. Bring mitigation receipts, roof, defensible space, sprinklers. Insurers and buyers alike care. If you're in a condo, audit your HOA's reserves and special assessment history. Insurance turmoil is hating associations too. Underfunded buildings appraise worse. If you're considering buying in 2025 to 2026, underwrite the whole monthly. Principal and interest, plus property taxes, plus verified insurance premium, plus HOA, plus a 1 to 2% annual maintenance reserve. Don't assume you'll figure out insurance later. In California, insurance is the deal. If you're eyeing a 5/6 ARM, model the first reset at today's SOFR plus margin with caps. If the payment still works, proceed. If not, don't gamble that rates will magically cooperate in 2026. If you're an investor, stress test rents at flat to down and capex at up 20 to 30%. In insurance stress zips, assume higher deductibles and exclusions. Watch the CRE maturity calendar in your target metro. Localized bank strain can starve residential credit if your deal pencils. Bottom line, California's housing market doesn't need a 2008-style subprime detonation to crash. It only needs a synchronized shove, insurance that can't be bound, ARMs that reset into heavy carrying costs, office loans that eat lender balance sheets, and a big winter that turns models into claims. The ingredients are already on the counter. Could the state thread the needle? Yes, if carriers return meaningfully, if rates fall further and stay there, if 2025 to 2026 climate seasons are merciful, and if CRE reprices without detonating banks' appetite for risk. Those are a lot of ifs. If you found this breakdown useful, share it with a friend texting you insane deals in Fire Country Canyons, or the cousin who thinks a fair plan quote is fine for now. Subscribe for the follow-up. I'll map the California zips where insurance availability is moving prices first, and the inland counties where SGMA, flood models, and job bases collide. Because the clock is ticking. 2026 is coming. Will you be ready?